Long drawn-out process of the Adcock saga could be coming to an end soon as the deadline looms for the shareholders' decision of CFR's offer. Joining us now to share his views on the situation is Mark Ingham, Director at Ingham Analytics. Well, Mark, you've drawn up a very nice report which puts everything into perspective, but as Alec mentioned earlier, proxies need to be in for those shareholders who won't be able to vote next week, Wednesday, if I'm not mistaken.
Correct. And, shareholders make up their own minds, and it's my job as an analyst who looks at things clinically and forensically to go through the numbers. There's a circular that's 2 inches thick with some very daunting accounting. So I think it's important that one does one's homework and you vote informed, if you will. And so that's what really I've done. I've put my cards on the table. And the upshot of that is that I think one needs to think very, very carefully and not just look at the bald, gross number that's supposedly on the table, but dig deeper into that, because there are implications, not just for the shareholders now and in the future, because you're getting cash and shares, so you'll be still stuck with the combined entity, but there are also foreign exchange implications too. And I think the claim of foreign direct investment is rather spurious.
Why?
The way it's put forward is that this is an influx of FDI, if you will. But FDI, has to be defined. And this is a straightforward takeover. This is a buyout of a JSE-listed company with a combination of some cash coming in, largely, almost entirely funded by debt, and some new shares. So to call it FDI and perhaps leave the impression that you're building factories and creating new jobs and so forth is not correct.
Looking at the mention as well of foreign exchange controls that you made mention of there regarding the funding offer, elaborate a little bit further on that.
Well, there are no foreign exchange controls as such. It's the funding mechanism that one needs to look at. There'll be at least $600 million worth of debt that will have to come with this deal. The balance sheet of CFR, let alone the cash flow situation of CFR, is incapable of sustaining that degree of debt. And therefore, the assets of Adcock are integral to making this deal happen. Without Adcock, there is no ability to actually fund that. And that's the assets of Adcock. And that has a significantly lower geared balance sheet than the overseas company has.
So just keep it real simple. Without Adcock Ingram being bought, they wouldn't be able to do the transaction because they're using the assets of Adcock to buy Adcock.
Correct, yes. There are elements here that speak to Section 44 of the Companies Act in that, the acquired company effectively is assisting the funding of the acquiree of the assets. And in fact, new equity will be raised in Chile. The outcome of that is as yet not quite certain. And that's another element of the deal that I've looked into, which therefore makes the final numbers that you get as a shareholder, the mix between cash and shares, not particularly certain either.
Mark, it's a great report. It certainly is the best I've seen so far. You've unpacked so many bits and pieces of it. But there were a few things that, and I suppose we can't really go into the complexities of it, but a few things that did concern me. The one was that we know that CFR share price is at around 119, 120, and yet the rights issue seems, according to your report, they want to raise capital at a premium to that. Did I get that right?
Yes, up to approximately 134 in fact.
But how did they do that? I mean, how do you raise money above your current share price?
They got a shareholders resolution. And bear in mind that the Weinsteins have, that's the family, who manage the business, have 73% control of the company. And in fact, if the deal did go through, they would still have approximately 55% of the company. So they're getting additional capital in from outside sort of minority shareholders. We're not sure whether in fact they will go 100% on that either. So
there's a lot of complexities, but
yes.
Bottom line, would you be, if you were an Adcock Ingram shareholder, because that's how you have to advise people, what would you be doing?
I think that it wouldn't be appropriate to accept the offer, given the uncertainties, given the implications post the deal, and particularly given the fact that Adcock Ingram, after the fact, will be in a rather poorer situation than it is today. Bear in mind that they have to pay down debt. They've got a significant interest bill. Combined, it would be about $76 million. And there would be a share of that. There would be a portion to Adcock. As a consolidated entity, of course, they could apportion cash flows, and that could mean further foreign exchange leakage.
The kingmaker, as we know through this whole process, is the public investment company. Given what your research has brought out, and given what you should know about what the PRC's philosophy is, are they likely to vote in favour?
They must speak for themselves. Again,
no, just if you had, you know what you've uncovered through your research, and you know what the developmental state kind of approach.
I really can't bring politics into it. I must look at it, as I say, clinically. And if I just simply look at it clinically from a balance sheet point of view, as is, and what could be, if you look at the scenarios and you model those, I think that even if you're a cold-hearted shareholder, I think you wouldn't be voting for this.
So what implications might this have on Bidvest's offer for Adcock?
Again, Bidvest's offer is in the public domain. People know what it's about. It's unambiguous. It's a clear cash offer. First come, first served, up to 34.5% of the company. It in no way imperils the Adcock Ingram cash flow balance sheet going forward.
What happens if the offer is rejected? What's going to happen to the share price? Let's just say that shareholders say, all right, we don't want to take the CFR offer. First come, first served, Bidvest gets it 34.5%. What's going to happen to the share price thereafter?
Well, Bidvest have made it clear 70 rand that they will give you. They currently have 7%, give or take. There is no certainty, indeed, that shareholders will decide to sell all of their shares up to 34.5%. So that is yet to be determined. And I think, given what we have at the moment with this particular vote, which goes through Wednesday, that's obviously concentrating people's minds. If, subsequent to that, it's voted down, then we have this option on the
But there'll be a rush,
table.
and that's the point I'm trying to get to. There'll be a rush to Bidvest until they get to 34.5% at 70 Rand a share. After that's filled, surely the share price would then go south.
There is the risk of share price falling. And in fact, I've had a fair value on this company of 55 rand for some time, and that's been a stretch, actually.
55?
Yeah. So we've got a bid premium to it. But there's tremendous value to be unlocked from this asset if it's done intelligently, and if it allows the company to build on its strengths, and let's not forget, Adcock has got numerous strengths. So I think there's a lot to play for over here. And I think with an enlightened shareholder, an engaged shareholder, and the resources to be able to take Adcock to the next level, I think shareholders could end up being, in the longer term, rewarded to a significantly greater degree than the option they have on the table right now.